So here is the Quest Diagnostics investor deck for 2023. I believe they made this presentation earlier in the beginning of the year, so it has been several months now, as right now it is in October. So it'll be good to see what their vision was at this point in time and how has their vision, their execution, their plan has been realized over the past few months. Key highlights. We are poised to grow based on our exceptional capabilities and relationships. We have the right strategy to accelerate growth. How do we know that is the right strategy? Right, that'd be curious to know. Investments in advanced diagnostics and CIT. What is CIT? And what kind of investments are they making in advanced diagnostics? Will drive profitable growth. Invigorate will continue to drive operational productivity while improving the customer experience. Is Invigorate a product? Is it a platform that they have that drives productivity? Let's find out. Long-term outlook for 2023 to 2026, I would consider this more as a midterm rather than long-term. So during this time, we're looking at about a mid-single-digit revenue CAGR and a high single-digit adjusted EPS CAGR. Introducing the Quest Way with an ambitious purpose and refreshed strategy and culture. Okay, why are they refreshing the strategy and culture? Was there something wrong with it previously? Purpose, working together to create a healthier world, one life at a time. Strategy, we help people make the best decisions to improve health by providing high quality and affordable diagnostic testing insights and services using our scale and extensive reach. Okay, so what they're focusing, what they're emphasizing is what they're offering is high quality. It's also affordable, diagnostic testing insights and services using their scale and their reach. Okay, so let's take a look later on at how they are distributing these services and these tests, and if in fact it has scale, and if in fact has reach. Collaborating with payers, providers, and partners to leverage our broad access, offering the most extensive menu of testing and services. Okay, so offering the most extensive menu, that's a big claim. So I think we should take a look at, how is that being measured, and whether or not if they do have the most intensive menu, and most importantly, how does this even matter, right? Does this even matter to patients? Does this even matter to people that are that might use diagnostic testing, right? Maybe they only care about certain tests. Maybe out of the 1,000 tests that are available, maybe there's only 20 that really matters, right? And much like Apple, for example, they're not looking to make every single electronic out there on the market. They don't even include all of the features that phones have in their phone, right? They just focus on the ones that really matter, and they do a really good job, right? So does an extensive menu even matter, or is it even a liability for the company by distracting them from what really matters? Leveraging our data assets and services to improve population health and enable value-based care. Continuously improving our quality and efficiency by embracing AI, automation, and other innovative technologies. Who we serve: patients, consumers, physicians, hospitals, life sciences companies, employers, insurers, retailers, public health agencies, and communities. So this will be interesting to see on how they are executing and how they are planning this. If they do have the data assets, the AI and the machine learning movement is really based on the data, right? The models don't really matter if your data is going to be the same as everyone else's. So really the advantage that you have in the realm of AI machine learning is really how proprietary your data is, and whether or not that can give you an advantage over other people that are using more common and off-the-shelf data. Culture, customers first, care, collaboration, continuous improvement, curiosity. Okay. We have an established core team and have added experienced leaders focused on profitable growth. Okay. Here we have James Davis, and we have a lot of SVPs, and they have their own focus, right? The chief financial officer, we have the chief commercialization officer. But why is that different compared to regional businesses? Why is that different compared to diagnostic services, clinical solutions, right? Should they be all under a single operational role, or should they be all under a commercialization role, right? So if these guys have the same level of authority, same level of seniority, and they're all sitting at the table, who is going to provide the leadership in this case, right? Or is it more of a collaborative effort, right? I just see right now, I think with all these people, there's a lot of cooks in the kitchen. So is that going to detract away from the strategy, and how cohesive is this group in a single room? Quest is the leader in diagnostic testing, insights, and services. Serves 50% of U.S. hospitals and physicians. That's very impressive. Now, is that exclusive, or are these hospitals and physicians using multiple services at the same time? Serves a third of the US adult population annually and 50% within 3 years. That is very impressive growth. Okay. Over 200 million requisitions in 2022, over 6 billion patient data points, 13,000 phlebotomists across 7,000 access points, 9,400 health and wellness professionals. Okay, what does that mean? Is that within their group, or is that within their network, or are these professionals that would use their services for their own patients? 4,000 couriers and 20 aircrafts. What does that mean? Do they own the couriers? Do they own the transportation vehicles like the 20 aircrafts? Be curious to understand what that relationship is. 26 regional and esoteric labs, about 5,000 medtechs, 600 MDs and PhDs. Are these internal or are these contracted, right? What does that relationship look like? In 2022, they generated $9.9 billion of revenue. Approximately 90% of our revenues come from physicians and hospitals. $8.4 billion was the 2022 base business revenues. $1.5 billion was from COVID-19. It's good that they separated that out. Okay, so I think here they're talking about the 8.4. 70% is from physician office. Health systems is 20%. Okay, so these are reference over 1 billion. So what does that mean? Is that the revenue? Professional lab services, 600 million. Consumer health and other consumer pharma services, employer solutions, population, right? Is there a risk item here? Is this a risk item, right? Is this an over weight on physician offices? Can they get more into consumers, direct to consumers, for example, or can they get more into hospitals, right? Is that what the health systems are, and how do they increase the share of their overall revenue split? Quest fully participates in an 85 billion US lab market. Physician lab services is 55 billion. Okay, so here we have the DGX at about 11%. Be interested to know who POLS is, hospital outreach, and other independent labs. So they are anticipating the total overall market to be growing at 2 to 4%. And I think what they have here is the total US lab market in hospital lab services. The overall growth is about 1 to 3%. So really the only way they can achieve growth is really competing more competitively. It's going to be a zero-sum game. So the only way they can increase their market share and grow their revenue at a faster rate is most obviously increase the market share. And secondly, introduce new products and services that is not currently covered by competitors and their current service offerings, right? But at the same time, when you look at this graph, you have about 43% of the market as other independent labs, right? What are these labs? Is it smaller independent mom and pop shops, or is it labs that are integrated to some degree very intimately with with grocery stores or with supermarkets or with physician offices, right? Is there a way that they can acquire this, right? If so, then this represents a very fragmented market that they can go after through M&A. For hospital lab services, they have only about 5% of the market. Other independent labs have about 13%. So I've been curious to understand why, between other independent labs and Quest Diagnostics, they only have about 18% of the market, right? Is it because the hospitals have their own offerings? Does it make sense for the hospitals to divest of these labs from the portfolio to focus on what they're really good at? Right, I think there is a structural shift that's happening in the American US hospital system across the country. I think more and more smaller hospital and regional hospitals are realizing that it is not financially profitable and sustainable to be doing everything and offering everything to their patients. So they're going to have to pick and choose what do they focus on. And for lab services, is that a service, is that an offering that they divest off to someone who really knows what they're doing in this space? Trends in technology and consumerism will continue to shape healthcare and favor Quest. Why is it that it will favor Quest above and beyond or instead of other competitors in this market, right? I think that's something we should ask. Advancements in genomic and oncology testing. Okay. I don't have a lot of background on this, so I think I'd be curious to understand a bit more about what this really implies. What kind of testing are we talking about? And how does Quest play a role in this advancement? We have greater adoption of artificial intelligence and automation. This I have heard and have known about for many years now. There's a lot of implementation of AI and machine learning in diagnosis or identification of abnormal cells in histograms. I think that's the right word, histograms, so the slides of different cells. So as you can see here, I think that's probably what they're doing. So The accuracy rate apparently, from last I heard, is actually very good compared to even a trained doctor, physician, or researcher in this space. So with the new movement in AI and machine learning, everyone looking at this space, I'd be curious to understand more about how they're implementing it. What are the liabilities that comes with this value proposition, right? Do they assume the liability if they're relying on the technology to diagnose patients, or is it going to be a filter and the final decision is going to be resting with the physician or with the interpreter of these tests? Even if they're acting as a filter, it is going to introduce some liability, because what if they filter out certain cases, certain tests that the machine learning or the AI deems as benign or as within normal limits, but in fact is not, right? So what does that liability look like for Quest, and how do they mitigate that risk? And then we have new point of care and collection devices, right? A lot of wearables. I think also there's been a lot of development in the device space for capturing oxygen levels, for capturing other data points of patients in their day-to-day. So I'd be curious to understand, what does that look like, and how does Quest benefit off of that? And consumers are more engaged in their healthcare. This is very true. There has been, I think, everywhere around, especially in North America, there's been more and more awareness of health. People are becoming more active, more fit. Also, how does that benefit Quest and out of every other company that is in the market? We have the right strategy to accelerate growth. Okay, so I'm curious to understand what they define and what makes them think that they have the right strategy. Physician lab services, 4 to 5% CAGR, partnering with health plans, value-based care, retail expansion. Curious to understand what this means. Are they referring to the model where physicians and healthcare providers are being compensated as a function of the value and the overall health improvement that they're offering in transition from a fee-for-service model, or is this something else? Right? And if that is the case, how do they benefit from a value-based care model? Retail expansion, what does that look like? What are some retail partners that they're working with, and how does the rollout look like? Partnering up with health plans, hospital lab services, it's growing at a 5 to 6% CAGR, expanding reference capabilities, PLS 2.0. What does that mean? Couldn't find anything specific online. I might imagine that this is, it's referring to the new form of physician lab services, possibly. Acquired outreach, what does that mean? What does that mean exactly? Consumer health, okay, why are we looking at $250 million of revenue instead of CAGR growth? Direct sales partnerships, menu expansion. What is this? Partnership with grocery? Is this partnership with points of delivery, right? And what does menu expansion mean, right? Is it offering the more tests? And it goes back, if that's the case, then it goes back to the question of, if they are expanding, is it in their right? Is it in their interest to offer the biggest menu possible, or do they focus on, in particular, very few menu items and delivering that and expanding that across the country, right? Or expanding geographically, right? So I think it'd be worth to speak to some individuals in the industry and understand a bit more. Menu expansion, what does that mean, right? Is that increasing the number of tests that is being offered on the tests that they offer to patients, to physicians? And if that's the case, it goes back to the concern that we had earlier: is it necessary to expand menu, right? Is it that there's only a handful of tests that 80-90% of the population care about, and adding the additional other 90% of tests, that's going to increase the unnecessary burden on Quest to have that offering, saying that they have the biggest menu on the market? And then for direct sales, how are they achieving that? These are strategies, but I think we have to understand a bit more before, as investors, we think and determine that in accordance agreement with them, this is the right strategy. I mean, we have to understand this a bit more. And then advanced diagnostics, not sure what that means. Long-term outlook, okay, so we covered that. So we're looking at mid-single digit revenue CAGR and high single, okay, so right, so that falls in line. Not sure how this fits into the overall revenue forecast. Right, first of three, physician lab services. We grow our physician business by leveraging our industry-leading health plan access. 90% access, we will improve access over the next 3 years. Okay, so they are already at a 90% access. Is it going to be a diminishing return to invest more time, more effort to increase that from 90% to 100%, or even 95%? Or should they reallocate their efforts and their capital into other more fast-growing, more lower-hanging fruits in the market? Right, something to consider. Focus on high access, low capture regions. Okay, so what does that mean? Right, so leakage programs, redirection programs, outreach acquisitions. Not exactly sure what these 3 items mean. As best as I can interpret, perhaps what they're saying here is they're going to focus on areas where they have the highest points of access, but there hasn't been a lot of penetration into the market. into those regions, even though they have the access, right? So perhaps that's what you're saying, and those might be the low-hanging fruits. So that would make sense on why they will focus their time there. Partnerships to engage with patients, physicians, and employers. Okay. So my question would be, how are they doing that? How successful have they been doing that? Is this a new initiative that they're doing? And what are the measurements of success that they have on this, right? So I'm curious to understand that a bit more. We're still on physician lab services. We expect to add $600 million in incremental health plan revenue through our expanded access and value-based contracting. 2026 revenue target from expanded access is $600 million. Okay, so here in 2018 we have 580. In 2022 we have $900,000 in target. So this would be in 2026. So that would be about 4 years from now. 4 years from now. So we're looking to add about $150 million per year. And that's looking a lot more like a low teens in terms of CAGR rather than a low to mid single digit. So I think there might be a bit of discrepancy here. It'd be good to understand why they're forecasting $600 million in incremental revenue over 4 years, whereas in earlier slides they're projecting a low single digit to mid single digit growth for revenue and EPS over the next 4 years as well. Right? So it'd be good to understand where that difference is coming from. Percentage of base revenue from value-based contracts. Okay, so I think this is it is what they're referring to in terms of shifting away from a fee-for-service to being compensated for actual healthcare value that they're providing. I'm not familiar with how those kind of revenues look like, but I mean, to the degree that their existing revenue is already 40% with value-based contracts, it does give me some reassurance that the revenue is there, right? So I think we have to look into how these contracts are based, how is it measured, how are they being compensated, and what are the implications as they increase from 40% to over 50%, right? And why would they be doing that? Is it because it is more profitable, or is it due to other reasons as per regulation or as per other reasons that might arbitrarily exist in the marketplace? As value-based care gains momentum, providers are taking on risk, are relying more on diagnostic testing and services. Okay, so we have, I guess, the flow chart from Medicare beneficiaries, Medicare Advantage, Delegate Lives, ACO REACH, large physician group. So they are taking on risk, more focus on early diagnostic prevention are key to managing risk. Okay, so value and affordable care are paramount. Okay, so let's think about that in a bit. Why? So is it saying that as these physician groups are transitioning to more of value-based care, and that's how they're being compensated, so they are being measured as a result of the actual health and overall health of their patient demographic, right? So if that is the case, it would be in their interest to catch diseases early on when they are treatable. So would that mean they are more prone to doing more tests, more diagnostic services, possibly? So I think we have to look into what that market really looks like. What are the motivations and what are the dynamics between these physician groups that are ordering the tests? Okay, CMS to transition virtually all medical beneficiaries to ACOs by 2030. Okay, so let's probably have to look into that a bit more. We augment our testing with a range of programs and services that enable value-based care. Comprehensive testing, breadth of testing across clinical areas, comprehensive solutions, data analytics and member insights, mobile phlebotomy services, health, coaching, and medication adherence, convenient locations for testing. Okay, be curious to understand what their geographical footprint look like, gap in care services, prescription check, food delivery. Okay, that's interesting. Why would that? Why would food delivery be part of their comprehensive solutions and screening programs? Okay, so what is that? What do these solutions mean? Right, so they have comprehensive testing plus all of these other solutions, right? And how does that complement their core offering? And how does that differentiate them? Right, it probably differentiates them in the fact that they offer these, but how does it help them? As the preferred provider in this case. Right, we have expanded our retail presence from patient services centers to COVID-19 testing centers to reach consumers directly. Initial relationships, I guess it's in these facilities, maybe malls, maybe plazas, pandemic partnerships, and now they are looking at reaching consumers directly. Curious to understand, how their initial relationships are like right now. Are they moving out of these centers? How does their partnership look like? Is that still ongoing? Yes, people are testing for COVID less frequently now, but the partnerships that they have made during those years, how has that benefit in their current operations and future opportunities? When did that start? How are they executing on it, and how is that being measured, and what does it look like right now? Okay, so they have some really good brand names here. Be curious to understand what do these partnerships look like? What do these relationships look like? Is it at a service level, or are they already integrated with their own operations, right? Are they offering these tests within the Walmart? Do they have a lease? Do they have, or is it integral to their value proposition, right? Be curious to understand that. Here we have hospital lab services. We are expanding, enhancing our reference testing solutions for health systems, improved health system workflow, utilization management systems, menu expansion to oncology and genetics. Okay, so they emphasize this, again. Be curious to understand how much value does the marketplace place on this. Discrete outsourcing, microbiology, cytology, pathology. Okay, so I think we have to take a closer look at what do these workflows look like, how are these implemented, and how are these integrated with the hospitals. What are these management systems, right? Is it an actual technology? Is it an actual system? Or is it more of a sequence of processes that they offer and work with the hospitals on? What does the menus look like? And for discrete outsourcing, what does that look like as well, right? I mean, what is the actual value? I'm definitely not that expert on these items, so I think we have to look at, take a closer look on, how much value does this offer to hospitals? Here again, we have PLS 2.0. So what does that mean again? We'll expand our offering to drive continued growth and help health systems achieve their strategic objectives. Okay, professional lab services revenue from $280 million in 2019 to $590 million in 2022. So that's a 28% CAGR. So these are, this growth rate is very high compared to what they're forecasting. So I'm curious to understand why their forecasts are significantly lower than some of the growth numbers that we're seeing here, right? Is there something that they're not showing? Is there something that they're dodging in this presentation? We'll have to take a closer look. Recent PLS relationships, okay, with Lee Health, Hackensack, Northern Light Health, okay? So these are some pretty big names. PLS 2.0 expanded offerings, support achievement of health system operational and quality metrics, provide solutions to alleviate workforce challenges, enhance the delivery of population health where it meets, and meet patients where they are. Okay, enhance delivery of population health. How are they doing that? How are they meeting patients where they are? Right. Be curious to understand that a bit more. Support achievement of health system operational and quality metrics. Okay. All right. What kind of metrics are we looking at? And provide solutions to alleviate workforce challenges. Be curious to understand that a bit more. But the growth numbers here, that is interesting. Is that expected to continue? We'll see. And these relationships, these are, Hackensack, I know for a fact that, they are a major player in the New Jersey area. So be good to understand what do these relationships look like and how deep does it go and what is the rollout plan for their lab services to these entities. Outreach, monetization, and support provide compelling benefits to health systems. Integrated data sharing, that is interesting, right? What is the liability? What is the policy around that? Is there any personal identifiable information that is being shared? And how do they clean the data? How do they monetize the data? Be curious to understand that a bit more. Enhance physician workflow and satisfaction. Okay, how is that being enhanced? And what is the current satisfaction, right? Are we starting off from a very low point, or are we already at a very high point and we're improving on that? Broadest test menu, again, is that, does that make sense, right? Is that a value point to the people that were in the test? We'll have to find out. And source of capital, not sure what that means exactly. Are they lending to the hospitals? Probably not, but we have to take a look at what this actually means. Okay, our recent launch of Quest Health is off to a good start, and this is under consumer health. So it seems that they've launched a new website, nearly double conversion rate, increased order volume and fulfillment rates, improved customer acquisition costs, and return on ad spend. Okay, so let's take a look at their website and see how it's doing and what it looks like. So here is the Quest Health website. It's very well designed. The UI UX is very nice. You can tell here that they really did spend a lot of effort and time on this. So it seems that they are offering the test direct to consumers. So you can test for testosterone, you can test for lipid, cholesterol, and it seems to be self-serve. Right? So let's take a look. We have all these different tests. Let's take a look at fitness. Wow. Okay, so we have the fitness profile seems to be self-serve. Assess blood-based health markers and insight to help you optimize your training. Okay, there's a typo in your results. Train harder, smarter, and recover faster. Okay, about the test. So how does this actually work, right? Is this a blood test or is it something else? So let's see if we add it to cart. And we have, so we would pay for it, but where do I get my blood drawn, right? At home So here we have, you don't need any special inside home collection kit on how you, right? So, okay, so we only need to collect saliva. That's interesting. Here we have is the men's health. So let's take a look at this, comprehensive. So, okay, so they want a blood and urine. Okay, so how do we, this profile provides a deep dive into your health and to paint a more complete picture of your overall wellness. It includes tests that may provide information about your heart health, kidney health, liver health, bone, diabetes, and other health factors. Okay, so preparing for the test, fasting for 8 to 12 hours is recommended if you are not able to fast before the test. Certain levels may be elevated if you take medication. Check your healthcare provider. Okay, still doesn't tell me how we collect the test, or how do we do the blood test. Is it under FAQs? Purchasing, payments, getting lab results, home collection kits. Okay, so this is interesting, right? Like this, you're able, I mean, if I'm able to get all of these tests, I mean, I would do this rather than booking a, right? If I'm doing this instead of booking an appointment with the doctors, and enriching the time, if I can do this all at home, this becomes a lot more accessible. So this is the first time I've seen something like this, and it's fascinating. But the one thing that's holding me back from ordering a test right now is how do I get a test done, right? Like if it's looking for a blood sample, am I going to be, putting a needle into my arm, in my vein, and collecting the blood? Not sure if I would be comfortable with that. So, but other than that, this is very interesting. So I think we have to look into, how the tests are being collected. Otherwise, this is definitely a big plus from what I've seen. I mean, I haven't seen anything like this in the past before, so this is very interesting. Here we have consumer health still. Our CIT business serves diverse customer types with different needs. What is the CIT business? Okay, so the top customer types: watchful warriors, privacy seekers, healthcare avoiders. That's interesting. So are they avoiding physicians to go with them for a self-test? Be curious to understand what that is about. Top test types: chronic diseases, STIs and STDs, comprehensive health profiles. This is promising in that chronic diseases are, to my understanding, more age-related with the senior demographic. So that's a main driver. And for STD and STIs, that's probably with the younger demographic. So they are likely at all parts of, they're addressing all age groups with their tests. And I think, to what degree, and I mentioned earlier, to what degree do we offer variety in the testing, right? If they're able to cover the major categories of the demographic or of the demand already, right? Is it worth going from 80% to 90% with diminishing return? We'll see. Strategy to reach our revenue goal of $250 million for CIT: drive direct sales, expand product portfolio, open distribution channels, unlock insurance revenue, help our customers beyond the test. Okay, so be curious to understand what that really means. How are they unlocking insurance revenue? How are they opening distribution channels? This we talked about. And how are they driving direct sales, right? Is it just with the website, or is it through other avenues as well? Advanced Diagnostics fuels growth in physician offices, hospitals, and among consumers across all clinical areas. Okay, so they are addressing all areas of healthcare, seems. Neurology, cardiovascular, consumer health, oncology, and so on. A platform approach. Curious to understand what that means exactly. Investments we are making will enable us to drive profitable growth in molecular genomics and oncology. Okay, so this is the third time they have mentioned this. I think it's really good for us to understand what that means really. What are the implications, where the market is going with that. Beyond what they're telling us, projected germline and somatic testing markets, right? So now they're saying germline, somatic. So right now, the current market is $15 billion. They're projecting it to increase by 100% over the next 8 years. That's a 100% over 8 years. So probably looking at about a 10-12% increase per annum. Okay, so yeah, 10% CAGR per annum. So what is it that they're doing to capture that growth and be part of that, right? And they can probably grow at a faster rate, right? Because if they can capture market value in addition to market growth, they can grow well beyond a CAGR of 10%. Invigorate will continue to deliver operational productivity while improving the customer experience through 4 major initiatives: leverage automation and AI. Okay, this is interesting. Why are they emphasizing leverage automation AI right here, where it hasn't been really mentioned previously, right? And are they at the do they have the technical capability to really pursue this, right? There's a lot of AI engineers, there's a lot of AI talent that is moving towards San Francisco, towards California. Are there sufficient talent and quality talent that can allow them to do what they want to do here? Reduce denials and write-offs, select and retain talents, enhance the digital experience. And we're looking at about a 3% annual productivity savings. So the key takeaways are that they are poised to grow based on their exceptional capabilities and relationships. They have the right strategy. Okay, so this is all mentioned in the beginning. So let's evaluate, right? They're poised to grow based on their exceptional capabilities and relationships. This has not been, I have not seen this yet, right? I don't know. I don't understand the scope of their delivery channels. I don't know what their relationships look like. There has been logos that are presented in this deck, but I don't know what those relationships actually mean and implicate. They have the right strategy to accelerate growth. That is unclear. They have a strategy, but to the degree of is it the right strategy, I don't know yet. Investments in advanced diagnostics and CIT will drive profitable growth. That I don't know either, right? Because they are forecasting the genomics and the oncology market to double in size. I think that's what this is referring to. Is that actually going to happen? Are they the only players in town, or are they going to be competing with others? And how are they going to outcompete others in that space, right? So is that going to drive profitable growth? We don't know yet. Invigorate will continue to drive operational productivity while improving customer experience. So I think they are referring to this slide, right? So is that going to happen? We don't know, right? And also a 3% productivity savings, that's a very small percentage in the day, right? It could be 0%, it could be 3% up or down, actually. So is that going to happen? And to what degree is that going to matter? I wouldn't hold my breath on it. And long-term outlook, this is more midterm. Long-term, in my opinion, would be more 10 years and plus. So this is more midterm. We're forecasting a mid-single digit revenue CAGR and high single digit adjusted EPS CAGR. So they're looking at higher margins. But I don't understand where that margin increase is coming from. It hasn't really been discussed in this deck. And the revenue CAGR and the growth of the market and what they could be doing seems to indicate a higher revenue CAGR compared to what we're seeing here, right? We're looking at 10% increases, 28% increases at one point. And why are they limiting their mentality in a sense of that growth rate, right? It seems that in the physician market, it's a very fragmented space with a lot of independent labs. Why cannot they pursue a more active M&A strategy? Is there a roll-up that can happen here, right? So it's not very promising to me that the key takeaways are not necessarily very concrete, right? These are up for negotiation, up for debate, it's up for interpretation. And it seems that, there's not a lot of creativity that's happening on how they can increase the revenue for the company, right? So that's my current opinion of the key takeaways so far. Pendex. Okay, so here we have just some notes on financials. Okay, so the diluted EPS. That is, okay, so we're looking at 2020 and 2021 at the highest. I imagine that's probably as a result of COVID. So we have $6.13 per share, increasing to $7 or $8 per share in 2022. So with the adjustments, we're looking at about $6 to $9 or $10. But, to what degree? Okay, so the COVID impact is actually not that much. So there were rapid increases in 2020, 2021. Why has the revenue or EPS dropped by almost half, right? That's very concerning. So here you're talking about their EPS, they're talking about their tax rates. Okay, here we have continuing operations, they're talking about their depreciation here. Okay, so we'll take a closer look at this when we do get into the financials. So let's take a look at Quest Diagnostic Incorporated. So here I'm using a tool called Coifin. It's the poor man's Bloomberg terminal, right? So it has a lot of good data that we can pull. So we are looking at 2019 to 2023. So here we are looking at the stock performance from 2019 to 2023. So that has increased significantly, but in 2022, that has dropped dramatically, right? And is that a result of their financial performance, or is this a result of the market with the rising interest rates? So here we have the main multiples on an annual basis. We have enterprise value to sales at about 2x. We have the earnings at about 17, right, for the last 12 months, and 13.5 forward looking. Okay, so it's not too bad. And book value of 2.2, so it's fairly in line with other healthcare companies that we're looking at. Their market cap is about 13 or 14 billion dollars. $14 billion. So they're looking at a market cap of about 10x of their earnings. And then let's take a look at their revenue. Okay, so their revenue has stayed more or less flat over the past 3 years. And then let's take a look at the cash flow. Net income is dropping, right? Net income dropped quite a bit, but most importantly, let's take a look at free cash flow, or cash flow to start. So cash flow is still in the $2 billion mark. They have about the capex is pretty stable. That's a good sign. Cash acquisitions, okay, so these are discretionary. And then we have investment in market securities. Okay, okay, so they did pretty well here, but nothing out of the ordinary that I would say. And now let's take a look at the cash flows from financing. So in 2020, they issued a lot of debt. I would imagine that this might be during COVID when the interest rates were very cheap. Or is that a refinancing, right? So it's probably a refinancing because they repaid this amount of debt in that year. And then they have they issued additional stock as well. That seems to be pretty regular repurchase of stock. In 2021, perhaps they thought that either because they have too much cash balance or because they thought that their stock was undervalued, they probably initiated a share repurchase in 2020 as well. That's a good sign. Common and preferred stock dividends, so that's very consistent. Be good to understand if they have a consistent dividend policy or not. And then other financing. So a lot of these seems to be discretionary, right? The refinancing, the debt repayments potentially is discretionary. The issuance of common stock, that seems pretty constant. But the repurchase, that's definitely discretionary, and that's a very good sign. So the net change in cash is okay. So there's a constant usage of cash. Be interested to know what their cash balance is. But let's take a look at the free cash flow. We're looking at about $1.5 to $1.8 million per year. Okay, so that is very good. That's stable, right? So what that number means is this is the cash flow that they actually can use at their discretion, right? This is the free cash flow that they can use to pay off, to invest in capex, that they can use towards dividends, that they can use towards share repurchases. So if they have a constant dividend repayment, so that's $300 million, right? And then another $400 million, so that's $700 million of. I mean, if we argue that the dividend policy and the maintenance capex is $700 million, and we subtract that from the free cash flow, actually the free cash flow would have been reduced by the capex already. So we're looking at about 1.2 to maybe $1 million of, $1 billion. Yep, $1 billion to about $1.5 billion of free cash flow that they are free to use for additional investments, for acquisitions, and so on. So that's a healthy amount. So we're also looking at about 14 times of free cash flow, which is not a bad figure. And looking at the balance sheet, here we have 2020 to 2022. So let's take a look at their cash balance, about $1 billion, and now they are left at about $300 million year end. I wouldn't be too concerned about the $126 million here, as this is still within the year. We would probably be looking at end of the year what that looks like. So they are actively reducing their cash balance, and their accounts receivable is pretty stable, right? Restricted cash probably has a covenant of their loans, of their debt. Property and plant, so that's been fixed. Goodwill, about $7 billion. Okay, and then here we have other intangibles. Okay, all right, so that's not too bad. And let's take a look at their debt, right? Their liabilities. Okay, so there's a total of let's take a look. There's a total of long-term debt, $3.44 billion. And they have long-term leases, deferred tax liability, under non-current. Okay, and then here we have the accrued expenses. So there's about $4 billion of debt on the books. Given the the amount of cash that they have, that's a very healthy amount, right? I'm not overly concerned. And then for the equity, so common stock, we have paid in capital is about $2.3 billion. Retained earnings. Okay, so I think they distributed a lot in 2021, so that's why it went down. Here we have treasury stock, and then we have so no preferred. There's no preferred stock. Okay, so let's look at some of the solvency metrics. So total debt to equity, 78%. EBIT to interest, 10. Okay, so that's really good, right? I mean, we're looking at about 10.5x from EBIT to interest, and even to include the capex, we're still looking at about 13x. Not a bad amount, right? And debt to EBITDA, 2x. So, they're in a very good, they're in a reasonable financial situation, I would say. In the return on assets, right? So we can take a closer look at this later on. But overall, their valuation metric seems to be in line with what I would expect for another, any other healthcare company in this space. And their income statement, or more so their cash flow, seems to be pretty healthy. There's not a lot of free cash flow that they can use at their discretion, and there's not a lot of debt on the books. The ratios are pretty good. So overall, my opinion of this company is that there's nothing that really stands out to me so far. I have to take a closer look at their geographic distribution. I have to understand why they are forecasting the revenue the way they are right now. I don't necessarily think they are undervalued, just based, at a very, very high level look at their multiples. I think, if the P ratio, if the cash flow, free cash flow to enterprise value ratio does start to fall by another, say 1 to 2 turns, I think it would make sense to take another look at this. But I think, this is worth putting on to watch list. Be interested to see how their share price performs, how their financial performance, shows in the next year, the next few quarters, right? Is it still stagnating, or is it starting to increase? And if it does increase, I think at that point in time, it'd be worth another look at. And we can do a more informal DCF, determine the valuation, and see what kind of trading strategies we can implement to invest in this company.